We're back again to talk about first quarter investments. We're going to talk about the economic situation, what happened to stocks, bonds, all the different investments that you have, and where we go from here. So I'm going to jump right into our three market themes for the first quarter. A lot of the data I'm going to show you is as of March 31st. Obviously, we've had a couple weeks, and I'm going to touch on that at the end about what do we do and really some changes since then. So let's dive in right away to our market themes. As you can see on the screen, we've got three main ones we want to talk about. So the first is just the SP 500 reached all new highs for the first quarter, and it has come off a little bit since those highs, but still had a great quarter to begin. And a big part of that, although earnings were still positive, a big part of that is prices going up. So valuations increasing just means what people are paying for earnings for the growth of the company is higher compared to those actual earnings that exist. Number two is profit margins are actually trending lower. So companies are still profitable, but they're not more profitable as a percentage of revenue as they were before. That is important because we believe in the long run, as you look at stocks, number one driver is earnings, and earnings are really just another way to say the profits after you account for everything, revenue minus all expenses, paying debts, paying taxes, all of that. What's left over is your profit, and that's earnings, and that's what drives long-term growth and the growth of the economy and the growth of the world, and the growth of the stock market is going to be earnings. And so if profit margins come down, that does suggest that we have some concerns looking ahead on how high things can actually go. In short periods of time, valuations can change dramatically. Long periods of time, earnings are what matter. And then number three, fixed income valuations do look favorable. Another way to say that is right now, bonds are paying higher than they have really since the great financial crisis. And that means it's nice to buy bonds. Even if the Fed, which we'll get to, even if the Fed doesn't change rates, you get to lock in some nice yields that you can earn, which is a nice alternative to stocks. We talked about this last year. Was there now is an alternative. There used to be the TINA, there is no alternative acronym that was used for many years, which basically said the reason stock market's up so much is because nothing else is making money. Now we actually do have an alternative, and that is in fixed income. And so we want to make sure to take advantage of that. Now that we have kind of talked about our themes, we're going to move to economic data and really just see a couple different charts that we have here, of various different pieces that are really all impacting the way that the markets are performing. So we've got four different ones we want to go through, and I'm just going to go top to bottom, left to right. So top left, we have U.S. unemployment versus the 12-month average. The biggest thing that we see here is unemployment is still very low, and it's not changing significantly. You've already started to see it go up, and so in the short term, you do have maybe a warning signal, but it's nothing close to something we need to be worried about quite yet. So more than anything, unemployment's still low. We just need to watch it. That's number one. Number two, if we go to the right, top right, U.S. core inflation, core CPI versus core CPI less shelter. These numbers are higher than what the Fed would like, and we actually just recently got some additional readings that were higher, and Fed Chair Powell came out yesterday, actually, recording this on April 17th, came out yesterday, talked about concerns of inflation being stickier than expected. That is still higher than the target. But if you look a little bit deeper, there are some nice signs. The U.S. core CPI minus shelter, so minus housing, that is lower, and that is a lagging indicator. So hopefully that inflation will come down and be below the Fed target of 2% that they have. Bottom left, we have U.S. real GDP growth. And what this is basically just showing is the economy continues to just hum along, making some nice returns of growing quarter over quarter after quarter. That's wonderful. We like to see that. We like the economy growing. overall. That's a good thing to see. One important thing is real GDP is actually taking inflation already into account. So that's a good number to see the economy is growing even over inflation. And then on the right, bottom right, this is probably, in my opinion, the most important thing for the rest of this year. And that is what the Fed is going to do. Every time Fed speaks, every time there's new economic data, it's all around what is the market going to do to react to a change in Fed funds rate. Is the Fed going to lower rates? At the beginning of the year, the market was pricing in, we can see this in the way that bonds are traded. Market was pricing in an expectation of the Fed lowering rates 6 times this year. We haven't seen it yet. Fed has not lowered rate. Now, with inflation being a little bit higher, being stickier, unemployment still low. We know it's ticking higher, but it's still low overall. The market is now pricing in only 3 rate cuts. And the first one probably won't be till after June is what it looks like from expectations. Okay, what does that mean? That means bond yields, bond prices have dropped, bond yields have gone up. You can buy and lock in a little bit better. If we bought bonds that were maturing in June versus bonds that were maturing in September, there's a big difference because an expectation that the rates at the time of maturity would be different. Now that you only have 3 rate cuts priced in, that's changing both market expectations for stocks and expectations for bonds and leaving yields a little bit higher. There's a lot of economic terms I just threw out there. Overall, that means now is a great time to buy some bonds. We want to lock it in. Rates are a little bit higher than they were earlier in the year. And the stock market could continue to be bumpy as economic data comes out and these Fed funds rate expectations change over time. So we just have to be aware of that. And you're going to see a lot of news, going into the summer. Inflation is a key driver here. And if we step back and say, okay, why does this even matter overall? There has been a expectation going back just 3 months ago that before the economic data suggests a slowdown. So GDP numbers dropping, unemployment going up, inflation coming down. Before that happens, there was an expectation that the Fed would lower rates to avoid it happening, basically. Now that these things are stickier, inflation's higher, GDP growth is still pretty positive, and U.S. unemployment is still really low, that is leading an expectation that the Fed's going to wait until the economic data turns, which means we may go into a slight recession, potentially, before the Fed actually lowers rates. From my perspective, I think this is a lot of conversation about nothing on what should matter as a long-term investor. But from a short-term investor or looking at the market or reading the news, whatever happens in the next 6 months is going to obviously dramatically impact the short-term market movements. But again, as we said on the previous slide, the most important thing long-term investors should focus on for U.S. stocks is the earnings, the profits of the companies you're investing in, not the short-term valuation change or the short-term interest rate changes. Now, as I said, interest rates have shifted, and so we're going to take a one quick look at U.S. Treasury yield curve, and I'm just going to walk through what these different numbers mean. You're going to see a couple different dates on here, and it's going to show just how this has shifted over time. So as you can see, we have a yellow line, which is basically saying a year ago, what was priced in, what were the bond yields you could earn by buying a short-term bond, a 5-year bond, a 10-year, all the way out to a 30-year bond. Then we have, where do we start the year? That's the light blue line in the middle. And then we have now the dark blue line at the top. This is basically, as of the end of the first quarter, what is currently priced in, what can we lock in if we buy a U.S. Treasury bond today, what can you lock in? And so you can see that across the board, the yield curve is higher. As an investor, that's great for you, because as we have bonds maturing, as you have cash that you're saving, as we have dividends and interest that are being produced from the portfolio, we can now buy at a higher rate without taking additional risks. So you can buy at 4.2% on a treasury bond with basically no risk, no default risk at a 10-year. And at the short term, the short end of the ladder, we can buy almost 4.6% if we go to a 1-year. There is an important factor happening here as well, though, as you can see that in all cases, we have what's called an inverted yield curve. So an inverted yield curve is essentially that short-term rates are higher than long-term rates. There used to be a lot of talk about how concerning that is, that's a sign of a recession to come. What's interesting is that it's kind of died down when a recession didn't happen right around the corner. Still something that in a healthy environment, you wouldn't expect short-term rates to be significantly higher than long-term rates. But over time, you can see that really after a couple years, it's very, very flat. There's not a big difference between a 5-year and a 10-year, for instance. And so that impacts when we buy individual bonds, where do we buy on the curve, and all of that. And I'm not going to get into all that nuance today. If you want to talk about bonds, Lauren on my team makes fun of me all the time that I can talk about bonds all day. So I'm happy to go into that discussion. But the most important thing here is just yields have come up across the yield curve, across different maturities, and we want to take advantage of that. So now that I've gone through all the economic data, different charts that we have here, let's finish up our recap of the first quarter by really just focusing on the actual return numbers. What did you actually earn in your investments? And so what I have up now on my screen, this is different asset classes, and I'll just go, left to right. The left third is bonds. So this dark blue that you see year-to-date returns, that's the same since this is dated March 31st. That's the same as first quarter returns. So on the left, you see that bonds actually haven't done that well, and that's what we would expect. So bonds across the board, when interest rates go up, you saw that chart on the previous screen. Interest rates go up, the price of bonds drops. So in the short term, interest rates changing by going up is bad for bond performance. But if you just hold those bonds at maturity, you're fine. So we don't have great performance here in the short term for bonds, but creates better opportunities long term. If we look in the middle, we have in this gray, that is equities or stocks that we have. So U.S. equities, especially U.S. large cap, did really well. So U.S. large cap stocks up over 10%. Small cap stocks were up 5%. International developed up 5.8%. And emerging markets continue to lag behind. That's up 2.4%. There are positives across the board. And when you look a little bit deeper into the data, for instance, international developed, international growth did much better than international value. You're making money in different areas of the market, which you have in all of your portfolios. And then on the right, we have in this blue, that is looking at real assets. Those are things like real estate. We have a broad real assets fund, commodities, including gold. Gold was one of the best performers in the first quarter, hit all-time highs, and looks like it may be breaking out and going even higher. There are a lot of structural reasons that we would expect that to continue. So as we look across the board, overall, I would say a pretty good quarter. As we think about where we started the year, if you read our initial outlook or you watched our initial video, I believe I talked about how if we look at past economic cycles, look at past presidential cycles, look at the current economic trends and data, there is a lot to suggest the first quarter could be pretty positive overall. And as I believe I said in that video, I do have some concerns that continue today as we look ahead to the rest of the second quarter, the summer, and going into the presidential election. There are a lot of changes in the economic data. We touched on those earlier. We also have all the rhetoric around all of our political situation. You've got obviously continue to have a lot of geopolitical concerns that all add risk to the market. And so as we look ahead, we want to be very intentional about the risks that you're taking in your portfolio. And if we think about a couple different risks that are in the short term off the top, I already touched on a lot of those. The number one is just volatility. As we look ahead for the next 6 months, let's say, volatility looks to remain pretty high, and you may not get the same upside in stocks as you had before. And so as we approach this situation with bond yields are higher, you can lock in a pretty safe investment with a higher return. We want to look into that, and we want to actually shift some client portfolios, especially if you're taking money out of the portfolio, if you are more risk averse in your investments, don't need to get as much return. We are going to be shifting and adding more bonds to your allocation. For those that we're going to keep the allocation the same, we still want to rebalance. We still want to take some gains off the table. So US stocks have done really well. Let's take some off the table, not be overly enthusiastic for the rest of the next 6 months, knowing that, again, historically, no matter which party wins, president, Congress, across the board, historically in a presidential cycle, from election day to the end of the year is actually pretty positive for stocks. So we don't want to go too far one direction, sell a bunch of stocks now and then have to buy back in. But let's not just be asleep at the wheel either. And so we're going to make some changes there. We also need to prepare for the possibility of data suggesting no cuts at all this year. Now, that's not talked about a lot. And I think if I had said that to you 2 months ago, you would have said, you're crazy. No one's talking about it. There's nothing out there that would suggest that the Fed's not going to cut rates this year. And I'm not predicting that that's going to be the case. But what we want to do is plan for all possible scenarios. And so one scenario is the data gets worse, and now Fed cuts not just 3 times, which is the market predicts, but maybe back to the 6 that was expected. On the other hand, I think there's also an equal probability that the Fed doesn't cut rates at all this year, and that data remains strong, inflation remains strong, and unemployment is still low, and the Fed doesn't cut rates at all. And we need to be prepared for that. And so on one hand, on the first scenario, buying more bonds now is great. If Fed cuts rates 3 or 6 times, somewhere in that range, you're going to do great with bonds. It's going to be a great investment to have. Stocks are going to do fine. On the flip side, if inflation remains stickier, we want to make sure that you're not underinvested in things like real assets, real estate, energy stocks, gold, and other commodities. And so as you'll see trades coming through over the next couple of weeks, which we've already started to do, you're going to see that we're going to make sure that you still have investments in all of those real asset areas that will do really, really well if inflation sticks around, while everything else maybe doesn't perform as well as we would like. And so we want to hedge kind of both directions. Want to make sure that no matter what market environment that we're in, you're going to be fine. And that's the goal of the investments. We want to take advantage of opportunities when they present themselves. We also don't want to be overexposed if something really negative happened or something people didn't expect. And so overall, what I want you to take away from this is the economy is still really strong. We've got a lot of data from Visa and MasterCard and net worth changes over time, unemployment rate, how average bank balance is. There's just a lot of data out there that's suggesting the economy is still really strong. And so let's not bet one way or the other what the Fed's going to do. Let's not bet that stocks are going to go up just because economic data is really good. Let's be well diversified, invest across the board in all the different investments. And that's what we're going to do. And that's what we've always done. So with all that, hope you enjoyed my rambling as we kind of go through. Happy to answer any questions that you have. We are also working on a few other blog posts upcoming about how we manage portfolios behind the scenes that I think would give insight to some stuff that you may not know about. And then also one that I'm really interested in. We're working on something on why is everyone so negative when the economic data looks pretty strong. So look for those in the coming weeks as we post various things. But thanks for taking time, and as always, reach out if you want to talk about anything. Take care.